Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. General Motors announced financial results from the third quarter of 2023 before the market opened today on Tuesday. Results were a little bit mixed, a little bit down from a year ago in a lot of aspects, especially on the profitability side. Revenue was up a little bit from a year ago. And we actually got some bad news from Cruise a little bit later in the day. The market didn't have a huge reaction. Stock was down about 2% in trading today. But I want to get into the numbers and how to think about this company and the stock long term, because there was a lot of nuance in the conference call going into the UAW negotiations, what they think about electric vehicles, and even how they're thinking about Cruise long term. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And I have a link to that in the show notes below. I think it's easiest to go to the presentation that GM gave to investors because this has a lot of the information that we need. This is a high-level overview of the quarter. To put some of these numbers into context, revenue of $44.1 billion was up from $41.9 billion a year ago. I'll get into where those changes came from, but a lot of that was just increased production of vehicles. EBIT adjusted $3.6 billion. And this is always one to keep an eye on. What is cash flow coming from the automotive business? That was $4.9 billion. EBIT adjusted margin. These margins is something you can keep an eye on across the auto industry, especially when you're comparing to companies like Tesla. 8.1% earnings before interest and taxes adjusted margin. So pretty good margins there. If we look at results compared to a year ago, you see a few changes. Earnings per share up a little bit. Margins were down. That is because sales were up. You can basically make up for those lower margins with higher revenue. There was also lower margins in segments like China. So some of those non-North American areas struggled a little bit more. This is EBIT adjusted. In the gray, you have the numbers from last year, and then the blue is the numbers from this year. You can see that GM North America down a little bit. GM International up slightly, but still relatively little profitability coming from them. GM Financial down a little bit. This was really to be expected. We've seen these financial businesses come under a lot of pressure as interest rates have risen. That typically leads to an increase in things like defaults and losses. It's just harder to make loans. So not real surprising that we're seeing EBIT drop in that segment, but it is still a profitable business. Cruise lost a little bit more money than a year ago, again, to be expected because they're investing in that business. EBIT adjusted down from $4.3 billion a year ago to $3.6 billion. As I mentioned earlier, this is what was impacting the EBIT numbers: volume. So there was an increase in production and price. Both helped that EBIT number, but people are trading down to less expensive, lower margin vehicles. So mix, there was headwinds there. Costs, there were headwinds. This was not really related to the UAW strike, at least not yet. So this was just things like higher raw material costs or normal labor costs. And then other is a lot of EV related costs associated with ramping up that business. This is the North America business. And you can see that revenue was up pretty nicely from a year ago. EBIT adjusted 9.8%. So that's a really solid number. Dealer inventory is 443,000. That is what's going to keep the company going and generating cash through this UAW strike. And then US EV sales is something they continue to talk a lot about. 6.6% market share and about 20,000 units sold in that segment. Cruise is the other area that there is headwinds as far as a financial perspective. Lost $700 million in the quarter, now down to $1.7 billion in cash. A couple of things I want to mention from the Cruise side. Mary Barra on the conference call did mention that they do have a plan for how they're going to fund this business long term. Cruise probably doesn't have enough cash to continue operations and continue scaling that business with just $1.7 billion in cash right now. So they said they'll talk about that in an investor day next year. We'll probably learn something before that because they'll probably need to raise some funds before that. Also, later in the day, we found out that Cruise's permit to operate commercial operations with no driver was actually pulled. That was related to safety concerns that they have. There was also some mention of Cruise making misleading statements or providing misleading documents. So we don't know a lot of details about that, but Cruise has definitely hit some headwinds in the last few weeks, especially. And today that really came to a head. So they're no longer operating in California as of the time that I'm recording. The DMV did say that there was going to be a path for them to get back on the roads, but we don't know exactly what that looks like quite yet. From a financial perspective, this is the GM financial numbers, and you can see that it's just a slow trend lower. Return on common equity dropped from almost 28% a year ago to 18% in the most recent quarter, but they did pay a $450 million dividend to General Motors. So you put all of this together, and I think it's kind of just steady as it goes for General Motors. This is not a stock that trades for a very high multiple, has really hovered around that mid to high single digits range over the last year. So frankly, if the company just continues to churn out cash and continues to return that to shareholders by buying back stock, which they bought back about $1 billion worth of stock in the last quarter, $1.5 billion worth of stock so far this year, that could actually make for a successful investment. If there's something at the end of the rainbow, I think that business, the growth business long term, is going to be Cruise. But like I mentioned earlier, there are a lot of headwinds for Cruise right now. Starting at least operations or mapping in 15 cities in the US. They just announced plans to expand into Japan, but a few incidents recently has led to them losing that permit in California. That's going to be something that we're going to have to keep an eye on. It's not clear right now whether this is something that can be remedied in the next few weeks, maybe a month or two, or if Cruise is going to be off the road for a very long period of time in California. And that was the biggest market. That's where it has the most vehicles operational. Also operating in Phoenix and Austin right now, with plans to expand into a number of other cities. So we'll see if that continues. On the UAW front, there was a lot of discussion about how GM has really been planning for this for a while, in thinking about it's going to have higher labor costs. So how are you going to deal with that? Well, you're going to try to automate more things. You're going to try to reduce the number of parts in cars. That's one of the reasons that they delayed some of the expansions or production at their electric vehicle plants. They want to lower those operating and labor costs. So management was a little bit hand wavy there. And the biggest guidance that they had was that they're still looking for low to mid single digit EBIT margins in the EV business. But we don't know exactly what those cost reductions are. It did seem very clear that they're seeing headwinds as far as a demand perspective in electric vehicles specifically. I think that's something that we've seen consistently across results from Tesla, Lucid, and even Rivian. Not only is demand maybe not what a lot of those companies thought it was going to be, but also pricing is starting to come down. So you're getting pressure from both the volume and the price perspective. And it kind of seems like GM is just stepping back and going, hey, you know what, we're going to start to move in this direction, but we maybe don't need to put all our eggs in the electric vehicle basket, because these traditional vehicles, trucks and SUVs, continue to do really well. So overall, I thought it was a decent quarter. Nothing to be really excited about. And the biggest questions were still unanswered right now. We don't know how long this UAW strike is going to last. We did find out today that it was expanding to another plant that produces SUVs and trucks. That's really where the bread and butter comes from for General Motors. So that's going to put additional pressure on the company. We also now know that they're going to scale back some of their EV investments. From a strictly financial perspective, that's probably a great move. They're going to save some money, lower costs long term. But does that leave them with less market share long term in electric vehicles? That is to be determined. And then, of course, there's those headwinds that I talked about at Cruise. That's ultimately where I think the value and growth potential for General Motors is long term. But if they're not operating in California for a long period of time, that could be a real headwind for Cruise. So this is still a stock that I own, still a stock that I'm bullish on. I don't want to take too much into these short-term challenges that may or may not change the long-term thesis. But this quarter didn't answer a lot of those questions. Still churning out cash. That's really positive. I like that they're buying back stock, but a lot of questions to be answered, both in the last quarter of this year and then into next year as well. So hopefully those UAW workers can get back to producing vehicles profitably, and we can get Cruise vehicles back on the road. But what do you think of the quarter and the direction that GM is going in right now? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.